Hi, and welcome to our LinkedIn Live series on the release of the ISM Report on Business. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management. That's Institute for Supply Management's member publication. And we're excited to have you joining us today. And we've certainly got a lot to talk about with the release of the Manufacturing PMI. Looks like the expansion in March was a little short-lived. The reading of 48.7% in May indicated contraction for a second straight month, and the sector just seems to be running in place right now. This picture has many moving parts. Demand remains elusive. Companies appear to be waiting on a call from the Federal Reserve on interest rates before making any big investments or initiatives. So I'm pleased to be joined by Timothy R. Fiore. He's the chair of the ISM Manufacturing Business Survey Committee, and he'll help us break it all down. And we're going to channel our inner Sesame Street nostalgia and say that this broadcast is brought to you by the letter S. And I'm sure Tim will explain that in a little bit. But let's just get to some questions as soon as Tim joins us.
There we go.
Here we go. We're good to go. Hey, yeah, Tim, I'm glad you're here with us. Lots of moving parts, as I said in the introduction, just a lot of dynamics in the data and the comments that we'll talk to throughout the broadcast. Just what are some of the things that stood out most to you?
Boy, I first got this report and I'm kind of scratching my head. I'm looking at it thinking, what is this? I'm looking at the numbers, the data. They're not moving much. And I started digging into the comments, and it became really clear after a few minutes into the comments because the same words kept popping out to me. The 5 S's. We're stable. We're steady. We're stuck. We're stagnant. We're flat. We're sluggish. Okay, looking at the whole thing that's exactly where we are. Then I got headline comments from a number of panelists that says something's changed in the last couple of months, meaning May and April, which, and Dan just mentioned to you, April was a month where we said in January that we thought we saw the beginnings of expansion. February, same thing. March, same thing, but weak. And in the first 3 months, we said weak. Not going to be any dramatic growth here. This is the issue with a soft landing versus a hard landing, that you're not going to expect a strong grow out when you didn't have a strong collapse. So, for every action is a reaction. It just stands to reason. In April, we had indications that, what's going on here? And then in May, more of the same. So, I think stagnant and stable is probably the best description here. And what's driving it is the lack of new orders. And what's driving because if you look at the PMI, there's 5 sub-indexes. One of them is future focused, new orders. The other 4 are operationally focused for the month, meaning production, employment, suppliers delivering, and the amount of manufacturing inventory on hand. So the future one, demand, is uncertain, and it's being driven primarily because of high interest rates. And as we started the year with our forecast in December last year, we're very optimistic of 5% plus growth in revenue. This is this is without the benefit of any rate cut indications from Chairman Powell that came out on the 15th of December. Our forecast came out, I think, on the 14th or the 7th. We didn't have any benefit of his projections for 2024. So it was all a tailwind for us. So here we were thinking that we're going to recover in a normal supply-demand cycle, better obviously than 2023. 2023 was less than 1% growth. And on top of that, we have interest rate cuts coming, which should only just kind of help us. Well, with the lack of any movement on the interest rates now, it's become a headwind. Because what's happening is our panelist companies and their customers are reluctant to make commitments in light of, stubbornness on interest rate reductions and geopolitical issues. I mean, the issues around the world are incredible right now. You got a war in the Middle East. You got a war in Europe. You got tension in Far East. You got an election year, highly contentious, and you got rates higher than people were hoping. Yeah. And it's frozen our manufacturing sector, which tends to be 6 to 9 months ahead of the general economy. So stagnant, stalled, stuck, all good words for May. We'll see where that goes. If we stay stagnant, stalled, and stuck, we cannot stay stagnant, stalled, and stuck, because the new orders will eventually eat into the backlog so bad that we're going to have to take actions to downsize. Our backlog is 20 months in contraction, coming up on 2 years, which is huge. And then look at what all that means from a liquidity standpoint. Look at the inventory number. Manufacturing inventory, 16 months of contraction. Would never have thought that. Well, that's a direct reflection of companies not investing in manufacturing inventory because, number one, they don't have to. They can force their suppliers to do that. And number two, they don't want to because they don't want to get stuck in a liquidity environment if something doesn't change here in the economic profile for 2024. So that's kind of the summary of the manufacturing sector for May. We're stuck.
Yeah, that's a great summary. There's a lot. You mentioned a lot that I want to ask you about later. I got a lot of questions, as you might imagine, and I know we only have a half an hour here, but we'll get to as many as we can. But I wanted to, you touched on it obviously a lot. It's obviously a big factor, especially in recent months when the PMI data comes out. Always discussed what impact it might have on it, on interest rates, how the Federal Reserve might interpret it. I think today, not only in the data itself, but in the reaction that I've seen, that sentiment has been as strong as ever. So, I mean, let's talk about that a little bit. As you mentioned in the semi-annual that came out in December, our respondents didn't know what Jay Powell was going to say. That data was collected before he made that announcement. And I know businesses don't want to forecast and budget based on assumptions, but you mentioned that it has become a headwind. I mean, is your sense that companies and executives kind of expected some movement by now on that, and there's a little disappointment on that, and that's reflected in the lack of investment that we're seeing?
Well, there's two here, Dan. The first thing is that our panelists expected a normal supply-demand growth profile to begin sometime in 2024, especially in the second half of the year. Remember, we said the second half would be better than the first half. So, and we thought the first half would be lumpy. And the first quarter was a bit lumpy, but generally it was in the positive direction. So that's how we started the year. And then that supply-demand, normal supply-demand dynamic did not materialize, primarily because the market was expecting interest rate cuts. And in the absence of interest rate cuts, they slowed down any kind of commitment. And the slowdown in commitment is really reflected in our new order number and the backlog number. So, the positive here is that our output number, the revenue number, the production number, surrogate for production, revenue surrogate for production. I know the inventory goes in there too. We can talk a little bit about that. We're stable April to May, and both of those months are good manufacturing months. So, okay, that's good. But how long can we remain stable from a revenue standpoint, which means our profitability is probably okay? How long can we stay that way without new orders coming in to fill up the order book and 20 months of declining backlog? You can't stay there forever. We can't stay stuck in manufacturing for the rest of 2024. We just don't have that kind of backlog. If we had the backlog, we could, 20 months. But we don't have that kind of backlog anymore. So at some point in the future, without something that drives our panelist companies' customers to start making commitments again in terms of CapEx and inventory, and be willing to make risks, to build product in anticipation of cutting lead times to their customers, satisfying the market demands. In the absence of that, we're going to end up in a contraction cycle here. Yeah. So you mentioned the prices, inflation, all that. And in fact, our employment number actually expanded 51.1. I think May is colleges all graduated. Graduates reported to work. Our seasonal factor reflects that, but you never know. I mean, you see more people showing up. You think we're hiring. I wouldn't put much into that because our hire to force manage number returned to a 1-to-1 ratio. In the month of April, we were 1.7 to 1, meaning we had 1.7 companies reporting hiring versus 1 reducing headcount. And now we're back to 1-to-1. So we've actually done a reverse. And I don't know if I mentioned this yet, but it's funny that I had a number of panelists comment that the last couple of months, they're not sure. They're not sure what happened. It's like everybody's scratching their head, which is exactly what I did when I saw this report, saying, what do I got here? And then when the panelists started feeding it back to me, you got a bunch of confusion. I'm not sure what you got. And then, stable, steady, stack, that all started to filter out of the general comments. This is where we're at. Now, the positive thing on the pricing side is that our price number, although it did expand in the month of May, not as much as April. So, and it appears we've got some weakening, especially in the steel markets, which is really more of an operational, regionally priced activity. It's really hard to ship steel around the world in its raw form. So I think that's positive. We got aluminum that's up. We got plastics that are still up. We got natural gas that's higher than it normally has been for the last couple of years. We're like 240 in MMBTU, up from 1.8. That's not good. And no signs of it dropping. That's probably a function of LNG shipments, but probably not that much. The injection season has started. We didn't have a cold winter, so there shouldn't be that much injection. Maybe wells coming out. It's an odd thing to see at this point. But our prices number, I think, was good news for the Federal Reserve. It shows a weakening of price growth. Our forecast update 2.0 in May said that we thought we were going to go from a 3.4% price growth in 24 to 1.9 now, of which we've already seen 1.6. So what it's kind of saying is the majority of our price inflation is behind us. That's a positive signal for the Fed. But they tend to look more at the PMI monthly number than the forecast because everybody has a forecast. But I like the forecast in conjunction with the PMI. It kind of fits together. So but that's kind of it. The employment,
let's go back. Let's go back to the employment for a second because one of the first things that I look at when the report comes out is I go to that table under the index that is indicative of how percentage of respondents companies that are hiring versus the same versus lower. And for this month, the percentage of companies that were adding staff was 17.1%. That's up from 16.3% last month. The percentage that had it the same was 69%. That's up from 67.9% the previous month. And the percentage whose headcounts were lower were 13.9%. That's down from 15.8% the previous month. So modest improvement, what you might expect to factor in to an index reading of 51.1. But you also mentioned that I know one that you track very closely is the hire to fire ratio. And it kind of leads me into one of these questions that I love to ask you that you can kind of make into a tutorial about how the report on business works. I mean, you mentioned not only the data numbers, but also how the comments and some of the ancillary data that we're talking about here are, make the report on business, useful. Kind of discuss that a little bit and just how it factors into the, the employment number.
Right. So you look at this 51.1, what is diffusion index, you take 100% of the betters, you take 50% of the sames, and you ignore the worse. So from a diffusion index standpoint, we definitely did better. Okay, that's good. But then you start digging into the comments. Now, not everybody provides a comment. So that's one of the weaknesses of the comment analysis. But, you take one along with the other. And we've returned to a 1-to-1 hire to fire ratio. So that coupled with the fact stable, steady, stagnant, stuck. All right. I mean, you're not going to go out and hire people when you're steady, stable, stagnant, and stuck. You're just not going to do that unless something's coming in the next couple of months. And right now, nobody knows what's coming. Everybody expects that there will be a rate cut. I think the consensus is November. So now you got to go another 5 months in this stable, stuck, stagnant, environment, and you're not going to hire people. But our numbers indicating that we expanded employment. Okay, we did. But then you dig into the comments and you see that, okay, we really, from a standpoint of sentiment, we're back to the not so good sentiment. At least we're not negative. We had a 1 to 1.3, I think, back in December or January. We're 1-to-1, but that's low. That's not what that says is stable, stagnant, stuck. So I don't see employment expanding in the near term. You couple that with our forecast 2.0, indicating that we're going to grow employment 0.3 points, nothing. I mean, that's error band stuff. Yeah. So we're stuck. We're stuck. So something has to happen. We're stuck in spite of the fact that we've got Inflation Reduction Act money coming in. We got infrastructure money coming in. We've got international defense money coming in. In spite of all that, and that stuff takes time, no doubt. In spite of all that, we're still stuck. Now, one of the comments that came out, which I found really interesting, was several people came back and said, well, we think the housing construction industry got off to a late start. Well, that wasn't driven by weather, unless you're talking about the tornado belt there in the center of the U.S. There's not a ton of construction going on there. There's some, obviously, but that's not what's impacting this. What they're saying is that there's a late start. Okay, is it a late start or a slow start? June is going to tell that story.
Yeah,
and we'll see what it says. If the comments continue to come back, and that's 30-something% of the U.S. economy, it's a big piece, and it filters through almost all of our industry sectors. Our chemical products industry sector, which is a foundational industry sector that everybody kind of has to get chemicals in their products. The other 17 essentially all use some kind of chemical somewhere in their supply chain. We're running at a PMI of about 51 for the second or third month. It's weak. By now, if that's an aggregator, by now that number should be 57, 58 with all the demand coming in, but there's no demand coming in, so it's weak. The transportation sector is still got low spot rates, and is another drop, month-to-month drop, April to May. I think I saw a number the other day that showed rates dropping 4%. That means there's no demand to move product, and whether it be e-com or otherwise, there's really the transportation sector has not gotten energized yet. And I think that has to be energized along with suppliers delivering later before we start to see a real decent recovery here in manufacturing. Yeah. So, and then, you look at, if people are holding on to their money, our inventory number contracts again, they're holding on to their money. Our CapEx, we thought we were going to expand 13% on our CapEx forecast in December. And now we've updated that to 1%. That's virtually nothing. That's impacting our machinery sector, our number 5 industry sector. I mean, they're in the mid 40s, the mid 40s. So, and they're a long cycle, long lead time, white goods, yellow goods, green goods, fork trucks, all that machinery and equipment you see around. They're hurting because people aren't willing to commit, take risk, and invest because they don't know what the future looks like. They don't know, maybe it's not just interest rates, because at some point interest rates are probably going to come down, stay on the trajectory. And if they're going to go down, okay, just wait it out. It's the election maybe coming in. You got 2 different approaches for sure on how to address the economy with the 2 choices that we have. You got these burning flames around the world that I don't think Americans quite appreciate the significance of that on our lives, not just our economic life, but our lives. Those things really continue to expand. So it's an interesting time. We're stuck stagnant. We can't stay here forever. We have to move. I think the only way it's going to move is some movement on the interest rate side. Our prices index probably gave the Federal Reserve some comfort. The CPI, PPI, PCE come out late. We're one of the early indicators of what's happening on the pricing side. Just like we kind of, when our prices went up, I think it was the April 1st report from March, we were the first indicator that we had prices going the wrong way. By the time the month was over, the PPI, CPI, and PC were all going the wrong way. Yeah. So now we got prices going up, but nowhere near where they were in April. Hopefully that's the right way. And I think the PCE came out for April, I think, which was positive. The core PCE was a positive number. That's good. You need to see CPI and PPI follow that. And then maybe we'll see some rate action. Maybe we'll see rate action, before November. And I think that would help. First there probably would be a telegraphing that, we think we've really conquered inflation. I think by far inflation is a much bigger issue here from the Fed standpoint than employment. I don't think they're really looking for large scale layoffs to reassure them that they've got inflation conquered. I think the wage numbers that came out with the PCE were positive too. They weren't hugely inflationary. I think it was high 3s wage increases, which, okay, we can deal with that. So I think it's now kind of assuring the markets that, okay, we're going to act. I mean, you don't have to be accommodative. Just be neutral. Go back to find a neutral spot.
Yeah.
Because I think, we debated last month about, are we really restrictive at 5.5, 5.25? And I think we are restricted. It's just taking longer for that restriction to show up. And I think the housing and construction markets are really good indicators. We've had indicators for quite some time that it's slowing down. But when I saw words about off to a slow start or a late start, that could easily be a low start from June, July. And then I think that kind of information going to the Fed, and they have a lot more information on this than I do, and ISM and the PMI panel. That will give them the assurance that maybe it's time to make a move.
Yeah. You mentioned determining if we're having a late start or a slow start, and I've discussed this with you many times when we've talked about inventories. See, it always seems to me in the time that I've been in supply chain or at ISM that inventories has got to be one of the most challenging disciplines. I don't know if I could do it, in terms of especially gauging demand inventory, where you've got to make sure you're not stocking too much because that costs money, and of course you don't want to avoid a stock out. But it seems to me, obviously companies are making a pretty safe bet that they can be conservative on their inventories until demand picks up. In fact, there was a comment that stood out to me. I think it was to the extent of, okay, yeah, we're starting to see demand pick up because of our orders, but it's going to be a long time before we place orders with our suppliers because our inventory is just fine. We don't need to make. So just talk about that dynamic and, where companies stand with that right now with their inventories.
Yeah, I think, I think overall, broadly speaking, the panelist companies, their inventories are probably close to right. When you got an environment here where suppliers obviously are looking for work, they're no longer overwhelmed. You have a supplier delivery number here. We've been 3 months into faster, but once you're down that 52 range, it's a weak supply base. So they're looking for work. They don't like to go through these cycles. Reserves and write-offs don't really work for small and medium businesses. The further down the supply chain you get, in many cases, you get into smaller businesses. So they're much more willing to invest their money to build inventory in the hopes that they can ship it in the future to their customers. And to some extent, that's probably going on because the customers are saying, I don't want it unless I can use it. And that's our panelist companies. I don't want it unless I can use it. So you want to go ahead and build it, go ahead. You'll have it when I need it. You're going to cut my lead times, which is what I'm looking for. But you hold on to that because I'm not going to do that. So, okay, that's fine. It's working fine. It will work itself out. The time where that becomes a real problem is when you end up in a hot environment and then you have a hard landing. And then you have all this inventory and I think the soft landing, as I mentioned several times, has allowed manufacturing to deplete their extended inventory over the large supply chain, meaning customer all the way back to the mill. Having a 2-year rundown has allowed us to burn off that huge backlog order books that probably set records. And 20 months into a declining backlog, we're still declining strong. I mean, 42.4, that's a strong contract. If that was a PMI number, I'd be really worried. So we're really still contracting backlog really strong. And at some point it runs out. And then when it runs out, you got to take layoff actions because you're not going to significantly build inventory. Eventually it catches up to you. When you build inventory, you eventually end up in a hole somewhere. So
yeah. Well, hey, we've talked about a lot, and we got a couple of minutes left, and I certainly, because we've talked about so much, wanted to give you the opportunity. I mean, is there anything that we haven't talked about or that I haven't asked, that you think might be important for our viewers to know about the manufacturing sector and where it stands?
Yeah. So I think, we've said for many, many, many years that we precede the general economy. I think that's true. We're 6 to 9 months out ahead of the general economy. And I think now with the Department of Commerce Q1 GDP numbers coming in weaker, that is really a reflection of when we were in the trough back in Q3 of last year. We thought we hit the bottom, and now you're seeing bottom-like numbers on GDP, 1.6, I think, 1.3, 1.6. That's weak. Those are weak numbers. Since the Obama era, we haven't seen a number that weak. Mm-hmm. So, that I think, fits in with the overall ISM PMI perspective that we perceive things. Mm-hmm. And then I think that, although we are weak, we're going to see a recovery here at some point. And in the meantime, we went from a profit-focused 2024. 2023 was liquidity-focused. Everybody went into 2023 thinking cash is king. When we ended 2023, it was more about, okay, profitability. Let's make sure we maintain profitability. We don't have to worry so much about liquidity anymore because we're in a recovery phase. Well, I think that's converted now. With the Fed holding back on any kind of rate cuts, 2024 has become as much a liquidity year as it has been a profitability year. And we're now coming up on the 6-month mark. We haven't seen a decent recovery yet. We saw a weak manufacturing recovery. Haven't seen a recovery yet on the services side. So liquidity is king, as reflected by the fact that we're not investing in CapEx, we're not investing in people, and we're not investing in manufacturing inventory, working capital. So that's kind of where we're at. We're stuck, but we're stable. It's primarily driven by lack of investment, lack of assurity in the economic markets, lack of confidence that when you make an investment, you're going to be able to get a return in a reasonable time period. It's a combination of rate, restrictive rates being in for longer, combined with an election year and the uncertainty around that, and with such stark contrasts of where investments will occur in the U.S., whoever wins the election, and the international climate of the three hottest areas in the world are not on fire, but there's definitely not good things going on there. Doesn't leave you with a warm, comforting feeling. Yeah. And then I think the transportation and chemical industry sectors are a good surrogate. There's transportation is still in a decline. It needs to recover, and the chemical products, which we followed into the slow expansion in January, we saw that coming all through 2023. The chemical products recovering first before anybody. We're above 50. We've been above 50 now for quite some time, I think 6 or 7 months, but we're not getting above 51, 52. And we are a cyclic index. That's what's great about the manufacturing PMI, is that it's early and it's cyclic. And again, we're not cycling. It's kind of like the trough we were in. This may end up to be an extended trough. Right now it feels like a plateau after a very weak Q1 growth. We'll see. We'll see what June brings. Yeah.
It will be an interesting month coming up. I'm already looking forward or curious about what the June data might say. That's a lot to talk about. Thanks a lot, Tim. Thanks for joining us today. For more information, go to ismworld.org, or in a little bit, you can read the article that I've got to try to encapsulate all the stuff that we've talked about. You can see how I did. It'll be up there in a little bit, where it details a lot of what we discussed here, as well as the reaction on the markets. And if you'd like to be a part of the ISM manufacturing services or hospital business survey committees that help compile data for the report on business, visit the website there on the slide, ismworld.org. Join the panel. Tim, I know you have some comments on that. Just talk about the benefits of being on that panel.
Yeah, if you're a manufacturing supply chain person, direct plea from me to join our panel. Not only is it informative, but you contribute to helping guide the decision makers, international economic policy makers around the world, not just in the U.S., but obviously the U.S. drives a lot of the international economic environment. With more panelists we have, the better. So direct plea from the ISM community, myself, and the group that works in supporting this whole thing, and the existing survey panel committee members, please consider joining. It doesn't take a ton of work. There's a little bit of setup to make sure that how you report fits in with our 10 sub-indexes. We ask very simple question: are you better, the same, or worse than the prior month? We ask you for comments too, but that's all elective. And the more the better. So you see the link on there. Please join. I've in my previous jobs, I've used it as an educational opportunity for my staff, not only to help them understand the overall economic factors that go into them keeping their jobs, but also helping them become better business people, which is what supply people are, by understanding commodity markets and the gives and take of supply and demand. So, and it's a really good way to build camaraderie and teamwork, with your direct staff and high potentials to be involved in this kind of thing. And you can see the net result of that by the report once a month. The table at a glance is really the moneymaker. So again, direct plea from myself, Christina, Paul, Rosemarie from the ISM community. If you please consider joining our panel, we'd love to have you.
Yeah, it's a great team. Our report on business team, they do a lot of hard work. And if you have a chance to contribute to the data that they crunch, definitely please do. And join us on Wednesday when we discuss the services PMI with Anthony Nieves. He's the retiring chair of ISM Services Business Survey Committee. And we'll also spend a few minutes with Tony's successor as chair. His name is Steve Miller. So for Tim Fiore and some good folks who helped us behind the scenes today, Christina Cahill and Jennifer Stevens, my name's Dan Zeiger, and we'll see you next time.